Welcome to the Deep Dive.
Glad to be here.
Today we're tackling a really interesting question, I think. What if the key to understanding asset prices lies not just with investors, but with the companies themselves?
Right. We're diving into something called the investment CAPM.
And we're using Liu Zhang's paper, The Investment CAPM, as our main guide for this exploration.
Exactly. See, for ages, the focus has mostly been on, what drives investors, their psychology, risk tolerance, all that. But today, we're kind of flipping the script.
Yeah.
Our mission, really, is to understand how the investment decisions firms actually make, like, real-world building factories, developing products, how that can be a primary force shaping asset prices, and ultimately the returns we expect.
It feels like a pretty fundamental shift, doesn't it? Moving from just investor wants to what companies are doing.
It is. And the core idea, well, it's pretty intuitive when you state it simply. Firms generally invest more when money's cheap for them, low cost of capital, and they pull back when it gets expensive.
Makes sense.
But the implications of that simple idea for understanding the market, they're potentially huge.
How so?
Well, the proponents argue this isn't just another way to think about things. They'd say it's fundamental, maybe even as foundational as the classic consumption-based CAPM we often talk about.
Oh, okay.
And what's really compelling, they argue, is that it might actually be more practical, better at explaining the patterns we actually see in market data.
More practical. Yeah.
By focusing on these firm-level actions. Some even see it as, like, a counter-argument to purely behavioral explanations for market oddities, offering a rational story.
A counter-revolution to behavioral finance. That's a bold claim.
It is, but it highlights the potential significance here. Ready to sort of unpack how it works?
Definitely. Okay, so where does this idea even come from? What's the theoretical underpinning?
Well, it's got roots in some pretty standard neoclassical economics.
Okay.
The assumptions like rational expectations, people trying to maximize their utility, firms trying to maximize their value, markets clearing,
Right.
that kind of framework.
The standard Econ 101 setup, basically.
Pretty much. The paper starts with a simplified model, just two time periods, T and T plus one, to make things clear.
Right.
And the crucial link is this. A firm's investment decision today, at date tool, directly impacts the dividends it can actually pay out tomorrow, at date T plus one.
So what a company plows back into the business now determines what cash it can return to shareholders later. Seems straightforward.
Exactly. But then, how do we value those future dividends today? That's where the household stochastic discount factor, or SDF, comes in.
Ah, the SDF. Always pops up in these models.
It does. You can think of it as, like, the price investors put on a dollar received tomorrow versus a dollar today, considering risk and uncertainty. If the future looks rocky, that future dollar is worth less today.
Okay, so firms are making investment choices based on how much those future payouts are worth, discounted back by how investors are feeling about the future.
You got it.
How does that help predict which stocks might have higher or lower returns going forward?
Okay, here's the core mechanism. The model suggests that if a firm faces a high cost of capital, maybe interest rates are high, or the market's demanding a big risk premium from them.
Right, it's expensive to get funds.
Exactly. They're going to invest less. It just doesn't make sense to pursue projects unless they offer really high returns to justify that high cost.
Makes sense. High hurdle rate.
And crucially, this lower level of investment today is linked to lower expected returns for that company's stock going forward.
Lower investment, lower future returns. Why?
Well, think about it. If the company isn't seeing or funding many profitable growth opportunities, the future potential perceived by the market is lower.
Okay, I can see that. What about the flip side? Low cost of capital.
Right. If money is cheap for the firm, more potential projects clear that lower hurdle rate, so they tend to invest more.
They put more money to work.
And that higher investment can signal and also drive higher expected returns. Investors see the company actively pursuing growth.
So the level of investment itself becomes informative. It's not just an output, it's an input for expectations.
Precisely. And it gets even a bit more nuanced. Consider a company that's really profitable right now, making good money, but they aren't investing much.
Right.
The model suggests that for the market to value this company appropriately, it must be applying a high discount rate to those current profits. Otherwise, why isn't the firm investing more? That high discount rate implies high expected returns.
Okay. High profits plus low investment implies the market demands a high return.
Exactly. And conversely, if you have low current profitability, but the firm is investing heavily anyway, that might suggest the market isn't demanding such a high discount rate. The investment makes sense even with lower current profits, so that implies lower expected returns.
Wow, okay. That connects profitability and investment in a really interesting way to expected
It
returns.
does. It's about the interplay between them.
So how does this investment CAPM stack up against the big one, the consumption CAPM, the one that links returns to our overall consumption patterns?
Theoretically, in a perfect world, in equilibrium, they should actually give you the same answer for expected returns.
Really? The same?
Yeah, they're derived from the same underlying economic principles, but the approach is very different.
How so?
The investment CAPM basically says, look, just focus on a few key characteristics of the firm specifically, things related to its investment activity and its profitability. The argument is that these characteristics are sufficient statistics.
Sufficient statistics,
Yeah.
meaning they capture most of what we need to know to predict returns.
Kind of, yeah. Instead of trying to measure something incredibly broad and difficult, like aggregate consumption growth and its covariance with returns.
Which is notoriously hard to do well.
Exactly. The investment CAPM suggests focusing on more concrete, observable firm actions and outcomes might be a more direct and maybe more effective way to understand the cross-section of expected returns, why some stocks are expected to do better than others.
So it's potentially more practical, empirically.
That's a big part of the argument. And this firm-centric view, it turns out, offers some really neat potential explanations for those market anomalies.
Ah, yes, the anomalies, the persistent patterns that traditional models have always struggled with, like the size effect, the value premium.
Exactly, things like that. The investment CAPM suggests many of these might just be different facets of an underlying investment premium.
Okay, explain that. How does, say, the fact that companies issuing lots of new stock often underperform afterwards fit in?
Well, why do companies issue stock? Often it's to fund new investments, right? Build new plants, launch new products.
Sure.
The investment CAPM predicts that higher investment today can lead to lower expected returns tomorrow. So the equity issuance anomaly might just be reflecting this underlying investment effect. Issuers invest more, hence lower subsequent returns.
Because the market sees they need the cash and perhaps already bids up the price, or the new investments aren't expected to be that profitable on the margins.
Something like that. Or maybe the high investment itself signals that the easiest, highest return projects are already done. And it's not just equity issuance. If you look at a broader measure, like total asset growth,
Just how much the company's balance sheet is expanding.
right, a comprehensive measure of investment, studies consistently find that firms with high asset growth tend to have lower future stock returns. Again, perfectly consistent with the investment CAPM's prediction, high investment predicts lower returns.
It still feels a little counterintuitive, though. You'd think investing more is always good news for the future. Why lower returns?
It's about the marginal investment. If a firm has to invest a lot to grow, maybe it indicates they're running out of super profitable opportunities and are now taking on projects with lower expected returns. Or perhaps the market efficiently prices in the expected benefits of that investment immediately, leaving less upside for future returns.
Okay, that helps clarify it. Now, the paper introduces a specific model, the Q factor model. What's that about?
The Q-factor model is essentially the practical empirical implementation of the investment CAPM. It proposes that you can explain a stock's expected return based on its exposure to four key factors.
4 factors. Okay, what are they?
You've got the overall market factor, just like in the standard CAPM. Then there's a size factor based on market equity, or ME. And then the two stars of the show, an investment factor, often measured as investment to assets, IA, and a profitability factor, typically using return on equity, ROE.
Market, size, investment, profitability. So it directly incorporates those core investment CAPM ideas.
Precisely. The theory really points to investment and profitability as the key drivers beyond the market, the size factor. Well, it was kind of added for practical reasons, partly because size is so prevalent in investment management and fund evaluation.
So less theoretically pure, maybe, but useful.
You could say that. And interestingly, subsequent research often finds that once you account for investment and profitability properly, the size factor actually loses a lot of its explanatory power for many anomalies.
Ah, so maybe size was partly picking up effects related to investment or profitability differences between small and large firms.
That's a strong possibility suggested by this framework.
And these Q factors, investment and ROE, how are they constructed? The paper says there's 0 investment portfolios.
Right, so take the investment factor IA. You'd construct a portfolio where you go long stocks of companies with low investment to assets and short stocks of companies with high investment to assets.
Long, low investment, short, high investment.
Exactly. You balance it so the net investment is zero. The return you get from this strategy isolates the premium associated with low investment versus high investment, theoretically stripping out market effects, size effects, etc. Same logic applies to the ROE factor, long high ROE, short low ROE.
I see. It isolates the specific return driver, and the market factor is just the overall market return.
The market factor anchors the whole thing, explaining the average return level over time, while the zero cost factors explain the differences in returns across stocks based on these characteristics.
Okay, makes sense.
Yeah.
So how does this Q factor model actually perform when you test it against the data, especially against the older workhorses like Pharma French 3-factor or the Carhart 4-factor model with momentum?
Well, the evidence presented by Zhang and others is pretty compelling. They run tests across dozens of known market anomalies, value, momentum, accruals, issuance, you name it. And generally, the Q-factor model seems to do a better job explaining these patterns. The unexplained part of the returns, the alpha, tends to be smaller and less statistically significant across a wider range of anomalies compared to the Fama French or Carhart models.
Even for momentum. That's
Yeah.
usually a tough one for rational models.
Even for momentum, while maybe not perfectly explaining it, the Q-factor model often shows improvement over, say, the Fama French 3-factor model in accounting for momentum profits.
That really does sound like a significant challenge to the status quo. The paper mentions a factors war. Is that what this is about?
Yeah, that term definitely captures the dynamic. For a couple of decades, Fama French was the dominant empirical model. Now you have this theoretically grounded alternative, the Q-factor model, that claims to explain the data better. It's naturally led to a lot of academic debate, comparison studies, and intense scrutiny.
And Fama and French haven't stood still, right?
Yeah,
They introduced their own 5-factor model in 2015, adding investment and profitability factors. How does that relate?
that's right. They added RMW, robust minus weak profitability, and CMA, conservative minus aggressive investment, to their original market, size, and value factors.
So they also recognize the importance of these dimensions.
Absolutely. Their motivation came more directly from valuation theory, like the dividend discount model. It implies that all else equal, higher expected earnings and lower expected investment should lead to higher expected returns today. They used operating profitability and asset growth as their proxies.
So similar factors, maybe slightly different theoretical motivation and construction compared to the Q factors.
Yes, and there are some subtle but important differences argued from the investment CAPM perspective.
Like what?
Well, one critique is about how Fama and French link these factors to expected returns via an internal rate of return concept from valuation theory. The investment CAPM folks argue that this doesn't always map perfectly onto short-term expected stock returns.
Okay.
Another point is about the value factor. HML, Fama, and French found it became somewhat redundant once they added investment and profitability.
Really? The famous value factor.
Yeah. The investment CAPM offers a potential explanation. Maybe the value premium itself is largely captured by the investment and profitability factors. High book-to-market value often correlates with low investment and sometimes lower profitability, which the key factor model already accounts for.
So the investment factor could be subsuming the value factor, in a sense.
That's one interpretation. And there's also a difference in the predicted relationship between expected returns and expected investment. Fama French valuation logic suggests a negative link via the internal rate of return, but the investment CAPM, looking at near-term returns and accounting identities, often predicts a positive link between expected return and expected investment.
Okay, a clear theoretical disagreement there. How does it shake out empirically when you compare the Q factor model and the Fama French 5-factor model directly?
It's still debated, but many studies, particularly using factor spanning tests.
Those tests that see if one set of factors can explain the other.
Exactly. Those often suggest that Q factors do a better job explaining the Fama French 5 factors than the other way around, meaning the Q factors might be capturing more fundamental drivers of returns. Independent researchers like Barillas, Shankin, Stambaugh, and Yuan have also published work generally favoring models closer to the Q-factor structure in terms of explaining anomalies.
So the evidence seems to lean at least somewhat towards the Q factor setup being more comprehensive.
That seems to be the direction much of the recent evidence points, yes.
What about the nitty-gritty, like how you measure profitability? Does that matter much?
Absolutely. The paper highlights this. Some early studies used things like gross profit scaled by current assets and didn't find a super strong link to returns.
Right.
But the investment CAPM logic suggests it makes more sense to scale profits like earnings or cash flows by the assets that were actually in place at the start of the period when those profits were generated, so lagged assets.
Comparing the output profit to the input assets at the beginning.
Precisely. And when you do that, and especially if you sort stocks more frequently, like monthly, based on profitability measures like ROE or ROA calculated this way, you tend to find a much stronger, more reliable profitability premium.
The details of the accounting really matter.
They do. Getting the measurement right is crucial for testing the theory.
Okay, let's circle back to that investment effect. High investment predicting lower returns. What other evidence supports this, besides just asset growth?
Well, we mentioned the equity issuance link, but studies have also looked at capital expenditure specifically or combined measures of investment and consistently found this negative relationship with future returns.
And this isn't just a U.S. thing.
No, the effect has been documented pretty widely in international markets too, which strengthens the case that it's a fundamental phenomenon, not just a quirk of one market.
Are there other potential drivers, though? Could it be about risk? Maybe low investment firms are just riskier somehow.
That's definitely part of the debate. Some argue low investment firms might be more exposed to macroeconomic downturns, justifying a higher return. Others look at investment frictions, like if it's hard for a firm to get funding, maybe that affects things.
Does not hold up.
The evidence on frictions is a bit mixed, actually. Some studies find that things related to trading frictions, like stock volatility or liquidity, might be more strongly related to the investment effect than financing frictions. And of course, there's the ongoing discussion. Is this effect entirely rational, as the investment CAPM suggests, or is there an element of market mispricing involved? Comparing results in developed versus emerging markets is one way researchers try to tease that apart.
Right. The efficiency question again. Now, let's flip to the profitability premium, more profitable firms having higher returns. How does the investment CAPM view this, and does it connect to things like earnings momentum?
The link is pretty direct in the model. Higher expected profitability, holding investment constant, implies a higher discount rate is needed to justify not investing more, hence higher expected returns. Now, regarding post-earnings announcement drift PED, that's the tendency for stocks to keep drifting in the direction of an earnings surprise for weeks or months after the announcement.
Yeah, a classic anomaly often blamed on investor underreaction.
Right. The investment CAPM offers a potential rational explanation for some features of PED. For instance, the theory suggests the impact of earnings news on returns should be concentrated around subsequent earnings announcements, as the market updates expectations based on sustained performance. That aligns pretty well with observation.
Interesting.
It also predicts the effect should be stronger for smaller firms, potentially due to higher information asymmetry or adjustment costs, which is also generally consistent with empirical findings.
So it provides a potential framework for understanding why KEED happens and why it has those characteristics without necessarily invoking slow investor learning.
Exactly. It represents potential progress on explaining something that's puzzled finance researchers for decades.
What about good old-fashioned fundamental analysis? Picking stocks based on financial health, where does that fit?
The investment CAPM actually provides a nice theoretical justification for why that can work. When analysts focus on profitability, financial strength, efficiency ratios, they are essentially identifying characteristics that the investment CAPM framework says should be related to expected returns.
So Piotrowski's F-score, for example, which identifies financially strong value stocks that outperform.
Precisely. That fits nicely. It suggests profitability is a key differentiator consistent with the model. It brings the theory back to concrete company analysis.
Okay, this framework seems quite powerful. The paper also mentions attempts to estimate the model structurally over multiple periods. What does that involve?
Yeah, that's about taking the theory beyond the simple two-period setup and seeing if you can estimate the model's parameters using real data over longer horizons, maybe even an infinite horizon. Researchers like Liu, Whited, and Zhang did important work here.
What do they do?
They developed a version of the investment CAPM that includes debt financing and tried to estimate how things like investment levels and stock returns respond to underlying economic shocks, like shocks to profitability.
And how well did it work? Did the model's predictions match reality?
They found a reasonable alignment, yes. The model could generate patterns in investment and returns that looked broadly like what we see in the data. For example, it could link returns to earnings surprises and book-to-market ratios in a way consistent with the theory.
Sounds promising. Any caveats?
Well, one challenge highlighted was the stability of the estimated deep parameters, the fundamental economic drivers across different types of firms. Ideally, those should be more constant. So while it's a valuable approach, there's still work to be done refining these structural estimations. It also relates to the broader Q theory of investment in economics, which, interestingly, has often struggled to explain investment decisions at the individual firm level, but sometimes works better when looking at aggregated data.
Aggregation helping smooth things out again.
Possibly, yeah.
This whole investment CAPM idea, it feels like it connects back to some really classic economic thought, doesn't it?
Oh, absolutely. The paper traces the intellectual lineage way back. You can see precursors in Bumborg's ideas about roundabout production in the late 1800s.
Wow, really?
Yeah, and especially in the work of Irving Fisher in the early 20th century. His theories on interest, intertemporal choice, and importantly, the separation of investment and financing decisions, that's foundational.
Fisher's separation theorem.
Exactly. The idea that firms should just maximize present value through investment, irrespective of shareholders' individual consumption preferences. And early finance scholars like Hirschleifer and Modigliani and Miller in the 50s discussed related concepts. But John Cochran's work in the early 90s is really seen as the key modern revival that brought these production side ideas back into the mainstream of asset pricing.
It's fascinating how the focus then shifted so heavily towards the consumption CAPM for so long.
It is. Part of it might have been the appeal and relative tractability at the time of the mean variance framework and focusing on the investor's problem. The consumption CIPM provided this elegant link between asset prices and aggregate economic risk. But modeling the firm side explicitly was often pushed to the background in mainstream asset pricing theory. The investment CIPM is really a deliberate effort to rebalance that.
And the argument isn't necessarily that the consumption CAPM is wrong, but maybe incomplete. The paper uses that Marshall's scissors analogy.
That's a great way to put it. Alfred Marshall argued, you can't ask whether supply or demand determines price. You need both blades of the scissors to cut. Similarly, the investment CAPM view is that asset prices are determined by both the demand side, investor utility, consumption preferences, and the supply side, firm investment production costs.
Two sides of the same coin.
Exactly. In equilibrium, they have to be consistent. Even Fisher talked about the rate of interest being determined equally by impatience, demand consumption side, and investment opportunity, supply production side.
And you mentioned earlier the investment CAPM might have an edge empirically because it avoids some issues the consumption CAPM runs into, like aggregation.
That's a key potential advantage. The consumption CPPM relies heavily on this idea of a single representative agent whose consumption tracks the aggregate. But we know people are diverse, their situations change. Aggregating that cleanly is a huge theoretical and empirical challenge.
The aggregation critique.
Right. The investment CAPM, by focusing on potentially observable firm-level decisions and characteristics, might be less vulnerable to that specific problem. It doesn't rely on perfectly capturing the behavior of one mythical average consumer.
That makes sense. It deals with more localized decisions.
Plus, there are the classic role critique issues for any CAPM. Can we ever truly observe the market portfolio, etc.? While not completely immune, the investment CAPM framework, especially when focused on characteristics, might sidestep some of those observability issues too.
Okay, so if we accept the investment CAPM as a valid, perhaps even more practical model of expected returns, what does that imply for how we think about market efficiency and those famous factors like size and value, book to market?
It offers a really significant reinterpretation. Remember Fama's definition of market efficiency. Prices reflect available information relative to a model of equilibrium returns.
The joint hypothesis problem. You can't test efficiency without assuming a model.
Precisely. For years, the default model was often the standard CAPM or maybe Fama French. When factors like size or value consistently predicted returns beyond what those models suggested, it was often interpreted as either evidence against efficiency, mispricing, or evidence that these factors were proxies for some missing risk factor.
Right. Value stocks are riskier somehow. Small stocks are riskier.
The investment CAPM provides a third possibility. It says, hold on, maybe the model of equilibrium returns itself needs to be based on investment and profitability. In this view, size and book to market might not be proxies for unknown risks, but rather characteristics that are correlated with or are manifestations of the firm's underlying investment and profitability dynamics.
So a high book to market ratio isn't necessarily indicating higher risk, but maybe it's indicating lower investment or certain profitability characteristics that themselves command a higher expected return according to the investment CAPM equilibrium.
Exactly. It allows for characteristics to be linked to expected returns within a perfectly rational, efficient market framework, just a different framework than the consumption-based one. It suggests the efficient markets hypothesis might be broader than just thinking everything is about systematic risk.
That's the efficient markets counter-revolution idea, again providing rational explanations for anomalies.
Yeah.
Characteristics can be sufficient statistics for expected returns in equilibrium.
You've got it. It's a powerful shift in perspective.
This has been incredibly illuminating. We've covered a ton of ground. To wrap up, what are some of the key questions or directions for future research in this whole investment CAPM and Q factor world? Where does the research go next?
Oh, there's still plenty to explore. A big one is continued testing of the reliability and robustness of the investment and profitability premiums globally across different markets and time periods. Is this truly universal?
Okay.
Another is trying harder to disentangle the investment CAPM explanations from behavioral stories. Can we design tests that really pit market efficiency against mispricing explanations for these effects?
The ultimate challenge, perhaps.
It is. Then there's understanding the cross-country patterns of other effects, applying the Q-factor model more rigorously to things like mutual fund performance evaluation, digging deeper into why anomaly returns often seem concentrated around earnings announcements.
Right, the timing aspect.
Exactly, and exploring the implications for areas beyond public equities like private firms, corporate finance decisions. How should managers think about investment if this model is correct? And how does it connect with accounting research on earnings quality and interpreting abnormal returns? Lots of integration needed.
It sounds like a really vibrant and ongoing research program.
Definitely. It's changed the conversation in asset pricing significantly.
So, to summarize for everyone listening, the investment CAPM offers this really potent fundamental perspective. It emphasizes the crucial role of what companies do their investments and provides potential, often rational explanations for many of those market puzzles that have been around for decades.
And for you, the listener, hopefully this gives you a new lens. It's a way to understand markets that goes beyond just thinking about investor mood swings or risk aversion and connects prices back to the tangible, real economic activities of businesses. Focusing on this firm characteristics investment, profitability might feel more grounded, maybe less abstract, than trying to gauge aggregate risk sentiment.
Absolutely. And it leaves us with a provocative thought. If asset prices really are so tightly linked to corporate investment, what does that imply for how we should evaluate companies, how we should build portfolios, how we even define market efficiency? Is the asset pricing story maybe more about the supply side, what firms are willing and able to invest in, than we've traditionally given it credit for?
It certainly makes you think, doesn't it? It suggests the decisions made in corporate boardrooms might be just as important for asset prices as the decisions made on trading floors.
Definitely something to mull over. We'd encourage you to explore the research on the investment CAPM and the Q factor model if this sparked your interest. Thanks for taking the deep dive with us today.
Thanks for listening.